You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That rocking bit of tunage means it is time once again to rock out with your friendly neighborhood hosts here on TWIFO. Yes, it's time for This Week in Futures Options, a program where we break down all the fun stuff going on the other side of the options fence, the futures options side of the fence. That could be metals, ags, rates. That could be energy, could be equities. You never know what's going to make it onto the program. Lean hogs, who knows? You got to join us every week to find out. That's what makes TWIFO so fun. You never know until showtime exactly what's going to be on it. My name is Mark Longo from theoptionsinsider.com. So, of course, from the ever-exciting The Options Insider Radio Network. Hopefully you guys are enjoying what you hear here. If you are, make sure you head on over. We don't care where it is. Could be iTunes, could be Google Podcasts, could be Pocket Cast, could be our app. However you like it, leave a nice little review so other folks can continue to discover the programs, how we keep that engine of new folks constantly discovering. We've been doing this for a while, 13 years. So we always like to see the new earlobes coming in and discovering the network and participating in the conversation, sending in those questions, those comments. We do indeed love to hear from you guys. And my old buddy, the guy usually holding down the Russell hot seat on the show today, Mr. Sean Smith, got stuck in a little bit of weather out there in the hinterlands of Chicago today, so couldn't make it into the studio. We had big plans for delicious gourmet burgers and all sorts of fun on the TWIFO program today. But he won't be able to join us, listeners. But never fear, we have an able guest joining us, holding down the CME Group hot seat this week. It's our old friend from the option block, the Rock Lobster, Mr. Andrew GIOVINAZZI from OptionPit.com by way of Carmen Line Capital. Mr. GIOVINAZZI, welcome back to TWIFO, sir. It has been quite some time.
It's good to be back here. I'm glad to have just an old equity option trader to pitch in on this show. But I will try my best segue into to future options.
I do believe the last time you were on with us, it was a decade ago. Does that sound crazy, sir?
I know, it seems eons ago that I was last on this show.
You do like your equity options, and of course we'll get to those. You are going to do double duty as the equity guy here today as well. But you have been talking a lot of energy and a few other things of late as well, which kind of caught my ear, which is probably why you're joining us on the program this week. But before we get to that, we always have to spin the wheel at the top of the show, Mr. Rock Lobster, and figure out what the big movers and shakers are for the week. What's lighting it up over there at CME? By the way, you guys can follow along. You can spin the wheel for yourselves. CMEgroup.com/TWIFO. TWIFO. That's where you go to get the reports, all the latest data, all that good stuff. Kick the tires and light the fires. If you do that, go to the market scan section. You can see exactly what we're going to do right now. So, Mr. Rock Lobster, I always ask our guests, I shall ask you as well, where should we start? Should we start optimistic and positive to the light side, to the upside, the big gainers of the week? Or should we go dark side and deeply cynical? Should we go to the downside? Where should we start, Mr. Rock Lobster?
Why don't we start with cheery, positive, and happy, because what the heck?
That's unlike you. Usually the cynical Mainer in you comes out and you like to be deeply cynical and dark side. So we're going to go light side. I think Uncle Mike has been rubbing off on you a little bit over there on that other program. Let's go light side. Okay, it's a weird one this week. All the top 5 names pretty much, maybe with the exception of one, really not huge options names. Kind of weird. That hasn't happened in a while here. Number 5, soybean meal, up 3.64%. That's probably one of the ones that has one of the most options overlay, but again, not a ton compared to the regular beans. Number 4, palladium, up 4.87%. Number 3, lumber, up nearly 5%, 4.92% on the lumber side. Number 2, iron ore. So a couple of stalwarts popping up here in the top 5. Palladium and iron ore, they've been moving a lot of late. 5.16% for iron ore. And number 1, with a huge bullet this week, RBOB gas, up 15.6%. That's just a huge mover. We might have to try to sink our teeth into RBOB, even though it's a little bit of a challenging one from an options perspective. But before I get there, let's look at the dark side, the downside, see what's moving to the downside here on CME this week. Number 5, our old friend lean hogs, off about 1.5%. Number 4, live cattle, getting a bit of a theme here, off 1.92%. Rough rice, off a little over 2.03%. Number 2, wheat, off about 2.5%. And number 1 to the dark side this week, oats, off nearly 3%, 2.95%. Before we start parsing all that good stuff, we got the numbers in from CME for January. It'll take a little while to parse their numbers, but we thought it would be a pretty interesting month given the fact that OCC and the equity options really knocked it out of the park in January. Thought it'd be interesting to see what's going on in CME options land in January, and it was a pretty strong month for them. Year over year, ADV up 1%. It puts them at about 4.03 million contracts. That's ADV now. Listeners, leading the charge, of course, is going to be rates with about 2.6 of that 4 or so million. Then equities with about 740,000. Energy, 331,000. Ags, a little bit shy of 250,000. The metals, 100,000, almost even. And FX rounding out the list there with about 46,000 out there. Some interesting nuggets that they noted here. Weeklies on commodity futures, so weekly options. Saw the second highest monthly ADV ever, led surprisingly enough by a record month for crude weeklies. Now, a record month for crude weeklies probably isn't saying much because, as we said many times on this show, the crude weeklies just don't trade. We've discussed it ad infinitum here on this program for over a year. People will trade tons of short duration stuff in the crude, in the WTI, just not the listed weeklies. It's a weird aberration. No one understands it. I've asked everybody. I've gotten a million different answers as to why that might be. The ags also saw seasonally high volumes led by soybean oil and lean hog options. How many times do you say that here on the show? And vol returning into the equity and energy markets. If you're wondering also what they mean by options on commodity futures, specifically they break that down. They're tracking gold in there, silver, crude, corn, soybeans, chai wheat, so they go Chicago wheat, and KC wheat. That's kind of what they're tracking there. So weeklies in those products lighting it up this past month. Mr. Rock Lobster, any surprises for you in those numbers, that which complexes are tearing it up, and any interesting nuggets in there for you, or is it all pretty much as you expected, sir?
None of it's as I expected. Why is RBOB ripping? I understand maybe why soybean might, because China and whatever. I could see how that could be pumping. I know that we have a couple people in our pro chat room that follow palladium a lot, and that just seems to make new highs every day. It's a crazy moonshot contract. So why is everybody buying lumber? Like these to me look like kind of bullish things, like economy-wise bullish. And the dark side is this just a result of, a year of tariff wars, and all of a sudden now the Chinese can't really buy anything because we can't ship them anything? Like, is that, I don't know, it looks like just the way this lays out, it's kind of it says U.S. are doing okay, and export of a lot of these products to China maybe not so good because, ships are sitting offshore waiting to go in or whatever. So it feels like prices are matching events. Let's say that. The prices look like they're matching events.
Yeah, a lot of interesting prices to discuss. You kind of touched it. We can't ignore it. It's moving so much. RBOB up 15%. It's not a huge option story. We're seeing some interesting developments out there on the refined side of the energy spectrum, a refinery fire and a few other areas maybe driving some of this madness here. But crazy numbers out here, and RBOB up 15% this week. Mr. Rock Lobster, I've kind of hinted at the top of the show, so that should help you. But RBOB, not exactly the most active of options contracts. So if you had to go out on a limb and guess how many total contracts traded in RBOB from an options perspective this week, go ahead. Take a flyer. What do you think?
Oh, gosh. So this is these are commodity future options. I'm going to guess for the week, 45,000 contracts.
Wow. You're an optimistic fellow. How about 849? That's why I say RBOB doesn't make it onto the show that often. Not a huge story there. So all of you writing in, I kind of do this just to forestall some of the inevitable emails and social media. Why didn't you talk about RBOB? We are. It's just not really an options story. Of that, 37.6% coming in that March contracts, the front contract. That's the biggest dog. And the biggest printout here, RBOB is at about almost 1.72 or so in that second month out future. The 1.67 calls leading the dance with 102 contracts. That's a lot when you're doing less than 850 on the week. So that's where the love is, near kind of in the money calls now. These are in actually April. Out here. So yeah, interesting stuff out here, but not a lot to can't really parse SKEW in 800 contracts. I won't bother with that. But I just wanted to put that out there in case anyone's saying, why, dear God, do you not talk RBOB? That is why. But Mr. Rockloff, so one of the reasons you're on here, I know you like your equity volatility. We'll get to that in a second. But one of the reasons you're on is you've been talking a lot about crude, and that's kind of on your radar, which kind of caught me by surprise because you don't really usually talk about that segment and the vol and what's going on out there. So let's start there. What's been lighting up your tape? What's been catching your eye out there in the crude space? What are you out there slinging these days, sir?
Well, the major oil companies, long-term crude vol, not very high. Just take your pick. I did a chart of when the Davos forum started this year, what was it, 17th or something of January? I have it on a chart somewhere. All the whole oil complex, literally the day of, just went to zero. I mean, it's like everybody walked off a cliff with oil. And these are commodity traders, but a lot of pretty big name oil stocks have insane dividends. And do you buy Exxon paying a 5.5% dividend? Or do you buy Italian debt paying, 1% positive rate? I think it might even be negative. Or you buy Greece at 1%. Like, the world is going screwy, So I think there's opportunity in oil. I think the volatility is cheap in there. If there's some more clarity on this virus thing, but I would say like May, you need some heat. To make all the virus stuff die. But yeah, maybe oil prices probably, I'm just saying, they should recover by May. And then all of a sudden, this is, you got multi-year lows in a lot of these products like the oil drillers and stuff like that. So I think there's an opportunity there. I don't know if it's like an all-in opportunity. I guess nothing's ever all in, but just interesting vol. I think the options are relatively inexpensively priced because there's just not a lot of upside. There's not a lot of upside potential in there. People are, I guess if BlackRock doesn't want to buy Exxon, that's trillions of dollars of assets, I guess, that aren't buying major oil companies anymore. So somewhere the worm has turned there. I don't know when it turns the other way. But volatility is, I would say, cheap to reasonably priced across at least the equity oil complex. And in natural gas too. I guess natural gas they can't even give away anymore. So it's weird. 10 years ago, we were peak oil and there was never going to be enough oil again, right? And how cyclical this is. And right now it's just, we're at the opposite end of the spectrum. And, you've got to nibble something down here on this stuff. Buying gas, oil, all of it. So anyway, that's what I'm doing. I don't know what anybody else is doing, but at least for me, it's easier probably to do in equities than it is in future options, because that's a different game as far as the length of time on investment and stuff like that. But I think the vol feels underpriced, at least to me. I don't know what you guys have been talking about on the show up till now, but I think that's at least what I see in the equity vol space, and I'm sure it sort of translates over to future world.
Yeah, you're right. It has something we have been talking about quite a bit. The vol has been fairly anemic. Our buddy Russell Rose has been on the program a few times talking about how crude is more of a vol product than maybe you might assume, despite the fact that things like the crude VIX, the VIXs, OIV and OVX never really resonated. By the way, are you still... Do you play a lot in USO? I know that used to be one of your preferred vectors. Are you more now into the individual names, Mr. Rocklopster, or do you still play in that one as well? Maybe XLE?
So XOP, I've been staying away from XLE, but I'm looking at it again just because I keep looking at stuff and it just keeps going down and down and down. I thought I was pretty smart in XOP around 20, and I'm not that smart. So I'm looking at that, and even USO, I think the vol in there is cheap, like longer term. The underlying products are kind of different, but it does look like it has some pretty low vol. So it looks like an interesting play from that point of view. So I'm basically buying options and all that stuff and see what happens in 2 or 3 months.
Now, we have a listener question a little bit later, so I don't want to get maybe too much into this, but I'm just kind of curious. I know you like a lot of the ETPs out there. What is usually the catalyst for you where you will go to the dark side of the futures options? What is it that you're looking for there that you'll trade those as opposed to, let's say, one of the broad oil ETPs?
Anything with future options, it's just bigger product and shorter time frame. For me, going to a future option it's time frame really, and the type of position you want to hold. So you just get a lot of bang and leverage for your buck, and in oil options and commodity options. So if you want that extra leverage, that's where you go. That's my easiest answer on that one.
Well, let's see where we're going here in the energy space. By the way, the numbers here for the energy options over there on CME this January. They're saying here volatility stemming from a slew of geopolitical events boosting energy options volume for CME in January. And that's no surprise here. WTI weeklies saw a record for ADV for the second straight month, so 2 months in a row, bolstered by what they're terming new participants and deepened liquidity. WTI crude oil options, the big mothership options, they're averaging 163,000 contracts a day. That's fairly active, with a record 21.5% traded outside of the U.S. hours. And, of course, nat gas calendar spread options continue to be highly active with an ADV of nearly 14,000. That's interesting as well. Let's break it down here really quickly. Yeah, the ADV 163,000 in WTI puts it up 38% year over year. So January was a rocking month almost across the board. There are a few light spots. I think rates were a little bit off, but outside of that, it was a pretty active month for a lot of the more traditional names we talk about here on the show. Since we're talking WTI, it's been a weird week, obviously, for WTI. A lot of things are going on out there. Obviously, all eyes are glued to China, what is going on in terms of the coronavirus, how that's going to impact demand. The weakness of demand has been an ongoing theme here on the program. That, of course, is translated into the weakness of the upside call skew out there in WTI options. No one really wants to touch them whenever there's a blip. We've had market makers and others on here in this product who said whenever there's a blip, it's just an excuse to fade more and dump more calls to the upside because they're not going to last. And that's pretty much how it's played out. We've seen several tumultuous events that would have in previous years really sent the energy markets rocking. Of course, assassinations, global tensions, drone attacks, other things that would have usually sent us spiraling upward, and yet the market pretty much shrugging them off. Coming into showtime now, we're seeing WTI up about almost 2.5% on the week. So back north of that 50 handle. That was a lot of consternation when it broke 50 to the downside. A lot of die-in-the-wool WTI watchers saying, watch out, once we get down there, we're going to stay there for a while. Not so much right now. We're up again, up about, a handle and change over the course of this past week. Again, this is just from Monday to now. Not, of course, since our last show. And looking at what's been going on out here, what's been driving it to the upside, there has been kind of some mixed signals. There have been rumors of OPEC and others making some strenuous production cuts to try to help stem the tide there. We're also hearing dire prognostications coming out of the IEA saying effectively they're cutting their world demand growth outlook. It's to the lowest level since 2011. That's, of course, on the heels of the fears of what's going on in China with the coronavirus. So a lot of dire things going on out there. And what's the big contract out here this week in crude? Well, it's the March contract going away in one day. Nearly half of the paper. That kind of reinforces what we were just talking about. It's very near-term paper here. Again, not in the weeklies. The weeklies, week 1 March doing 0.2% of the paper. Week 2 March doing 0.0 effectively percent of the paper. This week, 41 contracts looks like. But the actual listed monthly that's going out soon, that's got nearly half of the paper there. So it's a weird phenomenon of what they will trade and what they won't trade out there in energy. The number 1 contract this week, 50 puts going out in one day, 31,000 of those bad boys. So a lot of this back and forth over the 50 strike has really driven a lot of paper out here. Let's look beyond this really quickly. It looks like April 50 puts also doing about 14,000. So 50 strike across the board. Seems like it was kind of where the action was. 53 calls on the upside. Number 2, 18,000 of those bad boys. I'm not going to touch the SKEW because it's going away in a day. A vol is down pretty aggressively across the board. Most of these weeklies going out a few weeks now, getting annihilated here from a vol perspective, which is kind of interesting. And it's kind of, Andrew was just saying, vol is kind of low here, maybe getting kind of attractive out here at these levels. So maybe that's an area where perhaps you want to start looking at these levels. Just pull up our old friend here. There we go. All right, we want to look at our old friend, the OIV. That's, of course, the crude WTI VIX. That's at about a 36.25 out here right now. So interesting to see where we're level. Actually ticking up a little bit today, but over the course of the past few months, we're seeing it come. It peaked at about 42. That was back, not too long ago, a few weeks ago. So kind of on the lower end of that range, but not quite as low as we were back when in December, when it was about a 24 out there. Again, it doesn't trade OIV, but it's a great indicator if you're looking at these products to get a sense of where we fall on the overall implied vol spectrum. Speaking of implied vol and all that good stuff, we got to get to it now. Like I said, our buddy Sean couldn't join us today. Luckily, the Rock Lobster can do double duty out here. He cut his teeth in equity land, in volatility land. That's where we're moving to right now. Like I said, coming into showtime, it's a weird day out here. It's been a weird couple of weeks from an overall equity volatility perspective, as we're seeing, this will they, won't they dance with the coronavirus. Is it bad? Is it not so bad? That's really driving the markets. People are looking beyond things like micro things like earnings and everything else like that. The big drivers really have been overall these global pandemic fears. In fact, see me breaking out the numbers here for their equity index complex here over the course of the past month in January. Obviously, coronavirus driving a lot of volatility as a result. They're saying E-mini S&P, let's see, second largest pool of liquidity in index options during non-U.S. trading hours, averaging 148,000 contracts a day in January. That's up nearly 50% from last year. So overseas players diving into the E-mini S&P. Monday and Wednesday weeklies growing, accounting for 23% of total S&P 500 volume, options volume. Last year, that's in Maybe that means also for January as well. The E-mini NASDAQ volume surging 36% year over year. Bitcoin also doing well. We'll get to that in crypto in a little bit, even though they lumped that in with equity. And the E-mini Russell also having a good year over year growth, up 265%. Obviously a smaller baseline. It's growing from there, but still a lot of growth out there. Let's get to what's lighting it up today. And of course, let's get this week has been a weird one. We were talking earlier on our other shows today, bit of a sell-off in the market, a mild one. That seems like most of that has kind of mitigated itself. Now we're actually back in rally mode ever so slightly. The S&P effectively unched on the day. It was unched to the downside. Now it's unched to the upside. NASDAQ and others kind of following a similar trajectory. That means vol, at least for today, is kind of unched. The VIX about 14, 15 up about. That puts it up. Oh, let's see. Where are we from last show? It puts it up. Actually, it's going to be down from last show. Down nearly a full point. Down 0.85. Up today, down from last week. Remember, we were in a little bit more frothy vol environment last week. The VVIX, a.k.a. the volatility of volatility, hovering right around triple digits, 99. So close to 100. Got to start paying attention to the vol of vol at that point. And, of course, our old friend RVX, a.k.a. the Russell 2000 VIX, at a 1590. That puts it down almost a little more than half a point, actually, about 0.6, which means that spread is right around 1 3/4 points. That's actually a little bit wider. It's been very tight of late, but a little bit wider this week, about 1 3/4 points out there. All right, Mr. Rock Lobster, a lot to break down out there. This is where you hang your hat. Equity option, volatility option land, sir. What's been catching your eye out here from an overall equity volatility perspective, sir?
There's a couple of larger trends. So you have all-time highs in the S, and you still have VIX cash in the 14. I was 15 this morning, and it's 14 now. Normally it would be around 12. So liquidity providers have basically been dragging the at-the-money ball up with SPX because this coronavirus rally was they're like, this is crazy. So, and also like the magnitude of the moves, in a week, you're up 100 SPX handles or something like that, which is a lot, right? So if SPX is up 100 handles in a week, how much are you going to charge for a 30-day straddle, right? That's like $100. And $100 is like 11 or 12 vol in the SPX. So 30 days out. So you're like, the vol can't go down because we're moving too much. So I think the vol's fairly priced given the types of move we're having. We have kind of like an aggressive, fear of missing out type of market on the upside. And so at the second part, and then the marks, we're trying to figure out vol traders are figuring out how bad this virus is. And right now it looks like it's really bad for people that live in Wuhan and not so bad for everybody else in the world. Because apparently, there's no air flights or anything in and out of China. Borders got shut. Bang, that was it. So it almost sounds like there's more to the whole story than we know because, while the government, Chinese mouthpiece of the government is like, oh, you should be shutting this down. Nobody's really yelling very hard about that. And you're leaving cruise ships, won't let cruise ships dock. Like, something's not quite right with all of it. So I guess we'll probably learn in 100 years from now what that was. But, for right now, that's what we have. But volatility is looking at, generally vol goes higher when moves in both directions are easily possible. And vol tends to really depress when moves in only one direction are more likely, let's put it that way. So right now, that's what we have. We have a relatively high VVIX for where we are for just the reason I described. We're now moving past Super Tuesday, so you've got kind of the election, how that's going to play. That's around the 3rd, which I think will tell a lot of the story. For the Democrats, it looks like the Republicans kind of know who they're going to elect or they're going to nominate. So you have you have a couple of things here that are potentially market moving, and just the fact that the market's at an all-time high while that's going on, that just leaves a lot of movement potential, quote unquote, to happen. and we have been moving. It's just the way it is. Last week, this week, huge moves on. Everybody thought this virus thing was a no big deal. So, I think ultimately the market doesn't believe everything the Chinese government's saying. VIX will probably kind of stay at this level-ish, maybe get to 13, unless there's unless the problem gets a little worse, and then everybody's worried a little more about what's going on. So it's just kind of a floating vol where, the vol's very fair. It's a higher vol. It's a higher vol in a higher market price. So it's a more difficult trade for, I would say, like a long gamma vol trade or something like that. Like for me, it's too expensive for me to buy, and it's not expensive enough to sell. So it's not even Goldilocks. It's just annoyingly priced for me. So I think that's where volatility is. It's in a state that reflects kind of the strangeness that's going on.
Yeah, I gotta love when vol gets in that weird rarefied air, right? Where it's not cheap enough to buy, it's not expensive enough to. It's frustrating when it hits those levels. So I feel your pain there as well. Since we're talking E-mini before, let's touch on a little bit of that. Don't get the chance to do E-mini a lot here on the old program, and coming at Showtime, like we said, it's ticking up a little bit again. Net on the week, it's up about 55 handles, or about 1.7%. The big prints are still obviously in the equities. It's all in the weeklies, and it's the weekly. It's expiring with 1 day to go here. The 3,300 puts, we're at about 3,381 right now, listeners. 3,300 puts, even money puts, doing about 23,000. That seems to be the number one with a bullet. In fact, about 25% of all the paper in the E-mini going up in this contract that's got 1 day left to go. So they love themselves their weeklies out here in all equities, and the E-mini no exception. Worth noting, it'll go a little bit farther out to March, all the way out to March. Got to scroll halfway down this chart that shows how many weeklies there are out here in the E-mini. The 3,200 puts also pretty active, a pretty close number 2 here, with about 22,600 of these bad boys, doing a fairly active clip. About the big day was Tuesday with about 7,300. 6,500 on the tape today, slightly biased towards closings. Maybe some near term, not that far out the money puts here. Someone taking some of those off the table, but it seems like a lot of back and forth trading over here as well. Let's got to go a little bit farther out. We can't do SKEW with 1 day to go, so let's go out here. Where's the next big pocket? It's got to go out to March. That's where about 20.5% of the paper went up this week. The vol, obviously, as you mentioned before, is coming in. SKEW actually looks like a little bit of an interesting development. This March contract has 35 days to go. We see the puts were 23.5% rich. That now they're 27.2%. So puts getting a little bit richer out here in equity land. The calls 14.5% cheap. To the at the money now, they're getting cheaper, down to about 18.6% cheap. So calls coming in, puts getting a little bit of a bid. Kind of interesting out here in E-mini land. You don't see a lot of interesting evolutions to the SKEW that quickly here, that often in the big indices. And interesting to see out here. Some people who dismiss equities, the SKEW is always the same. Well, clearly it's not. It evolves. The shape never changes, but the slope will adjust over time. Speaking of equities, before we move on, Mr. Rock Lobster, you're doing double duty here. You're holding down the CME hot seat, but of course our buddy Sean here couldn't make it as well. I'm curious for you. You interact with a lot of the bleeding end of the retail spectrum. I know a lot of them come to you for, S&P 500, vol, and all that good stuff, volatility, VIX, the futures, all that stuff. But how often do you guys segue into small cap like Russell 2000? And then also, what are your thoughts? It's been kind of an interesting one to watch because the narrative for the small cap stuff is it's exclusively domestic. Doesn't really play a lot with these macro trends, and we're in a predominantly macro-driven environment right now. We're seeing pretty big moves. The small cap, the Russell 2000 up almost 2.5% here this week. Vol coming in pretty aggressively. So small caps moving and shaking as well. Are they light up your radar at all these days, Mr. Rock Lobster?
They are mostly just because the oil. There's a lot of producers and stuff in there that I'm looking at, and they're literally at the lowest prices. If you look at like an ETF like XOP, a lot of that stuff is in the Russell. It's at it hasn't been this low since a financial crisis. Or I think actually this is a new 5-year low. So I think there's a lot of stuff in there that makes it like relatively a bargain. And as from a vol point of view, I mean, all the SKEWs tend to kind of move together. All the big equity SKEWs, give or take. Sometimes if a big sector is blowing out one particular index, but they sort of move, they sort of dance the same tune for the most part. But looking at so there is like a little bit for SKEW, but it's not. I would not call it insane. It's not very high as of right now. That's the easiest way. Just looking at a lot of short-term butterfly trades and stuff like that. There isn't a lot of what I would call short-term edge. Like I said, everything is priced in more or less relative to the at the money in the annoying zone. It's not super fat. It's not super cheap. It's just freaking annoying. And I think the reason is, it gets to the point where since the liquidity provider doesn't know what to do, they just, there's not a lot of conviction one way or the other. So there's no, the stuff is not totally bid in one direction because everybody has a lot of conviction in that direction. It's in the SKEW, as let's call it, in the annoying zone. It's not zone of the monk. It's not zone 1, 2, 3, 4. It's in an annoying zone, I guess.
Yeah, I hear that. Speaking of zones, maybe annoying, maybe we're outside of it a little bit now. One of the things that people like to look at, I know, when they're looking at a small cap versus the large cap, is that spread of vol, right? That's where really things tend. That's why we talk RVX versus VIX every week, because that's a huge driver. I know from the past, especially when RVX was listed and could trade, that was a huge driver for volume in both. Once that spread got pretty wide, people will start coming into play, small cap versus large cap. When it gets pretty tight, same thing. And we're seeing it's not quite as tight as it was last week, but still pretty tight, right around 1 3/4 points. I'm curious, do you have a barometer, Mr. Rock Lobster, where that spread starts to look attractive? And if so, are we anywhere near it on the tight side right now?
I don't look at stuff that I can't trade very often, I have to say. So as far as where that is right now, I think it's the same thing. A lot of these indexes and a lot of the vols are they're not displaying anything, radical. Look at what's going on with the Russell in general. You're not having you're not having like the power performance. I guess so, right? It's at the highs of the year, but it's not diverging a ton from the SPX. So if you don't have like crazy, like sort of anti-performance, it's hard for the SKEWs to get too far out of whack. Does that make sense?
No, yeah, I agree, and I'm with you. I would love to have the return of the Russell VIX product, and we could trade both of them pretty directly from a vol-on-vol perspective. You got to kind of leg into it with the options now instead, which still could be done. But you're right, it's a little bit more laborious. That's why we keep pushing everybody involved. Launch more vol products. It's good for everybody. Right now, we always talk about a lot of downside puts in Russell. In fact, I think we've listened to a question about that a little bit as well. But it's actually 1,700 calls. Russell's threatening 1,700 right now, 1,697.70. 1,700 calls in March, leading the dance with about 34% of the overall paper out there this week. So active week out here for upside, kind of bucking the trend a little bit. Speaking of active weeks, we're just looking at the dark side and the light side here coming into showtime. And there was one kind of product category that seemed to be, shall we say, dominating the tape out there, and that's ags. Ags lighting it up. Number 5 on the light side was soybean meal, up 3.64%. And to the downside, to the dark side, we had oats at number 1 with off nearly 3%, wheat off about 2.5%, number 2, and rough rice off about 2% for number 3. So we got to do a quick stop in ags. I know, Mr. Rock Lobster, this is your favorite product category. You can't stop. You won't shut up to me about all things ags every day. I'm getting these IMs and messages from you to see what's going on in soybean oil today. So, and I know this is right up your alley. Looking at the numbers here from CME for January, it was an interesting, like we said, an interesting month for ag options out here. Obviously, trade war and also virus fears. China, a big driver for ag demand, and that was driving a lot of paper out here as well. The possibility, the hope of stronger ag exports in 2020. How that can happen when half of China or a good portion of China is shut down, that's no one was planning when they made that trade deal. A little pesky thing like a pandemic floating around there in the ether. Soybean oil volume doing big numbers. Saw that moving again this week. That's of course related to what's going on in the palm oil market, and that's a higher vol out there as a result. So that translated back into soybean oil. We also talked about livestock, the USMCA that got signed into law that impacted the livestock, of course, as well as a large hog slaughter for the last week of January. Not something we talk about often here on the show, but lean hogs have been moving, coming in at 2.707 million head, 14% higher than the same week last year. So slaughtering more hogs, all that driving a lot of vol out there. Lean hog volume, option volume up 54% year over year. Soybean oil options volume up 137%, easier for me to say, year over year. And KC wheat up 76%. Let's look really, by the way, the big player out here in the ag complex is corn with about 73,500. Number 2, soybeans. This is ADV now. 53,000. Then Chicago SRW wheat, 28,000. Kind of falls off from there. Lean hogs actually doing 18,000 contracts. So growing over there from an overall options volume perspective. Class 3 milk averaging 1,800 contracts a day. Getting up there. It's on our radar quite a bit. Let's look at the oil here really quickly because that's what was moving out here in soybean oil. That's big volume growth. 33,000 contracts so far this week. So pretty decent paper out here. Soybean oil, if you don't follow this thing on a daily basis, about 30.75 or so right now. 30.75. That's off a little bit, about a quarter of a handle, not quite 1% here on the week. So nearly half of that paper, decent paper, coming in that March contract, which goes out in about 8 days. If you're wondering, it's the 32 calls, not 31, 32 calls. So more than a point out of the money calls, lighting it up with the big print this week. 4,300 of those out here. We won't bother with SKEW and things. Let's try a couple of more. Let's go back to the actual beans themselves. Haven't had a chance to talk about them too much on the show of late. Beans obviously do a little bit more volume, nearly 150,000 contracts on the tape. This week they've also been very much ground zero for the trade war. And perhaps we shall see if this will be further impacted by what's going on out there with the coronavirus. The beans threatening 900 even, 895.75 right now. So ticking up here on the week, up about 1.5% here. So a good week, not quite breaking into the top 5, but a good week. And again, it's near-term contracts. It's the March contract expiring in 8 days, doing 43% of the paper. That gets back to what they were saying earlier about the commodity weeklies tearing it up right now. That's pretty much the case here across the board. If you're wondering, it's the 880 puts, number 1 with a bullet out here in March that are doing about 11,500 contracts. That's the lion's share of the paper out here. Let's go out a little bit farther. Let's look at some SKEW before we move off of the beans. Let's go out to April. That's got a full 43 days to go. So a little bit more calm, cool, collected heads out there. 17.2% of the paper this week. So enough to parse some SKEW out here. Let's see, the puts, kind of quiet on the put front out here. The puts were 1.2% cheap, so pretty much in line with at-the-money vol. This week, they're 1.6% cheap, so down a little bit, but not a ton. Calls were where the action was. Again, not surprising maybe given the underlying movement this week. The calls were 3.5% rich to the at-the-money. This week, they're over 6.1%. So calls catching a bid, puts kind of middling to unched. Kind of interesting. We talked before about some interesting setups for collars in soybeans. Certainly when we first launched TWIFO a few years back, that was glorious collars days. The puts were expensive, the puts were cheap, so you could buy them for nothing. The calls are super expensive, so you could sell them and actually get those collars for a nice tight collar for a credit. I don't think we're quite there yet, but maybe interesting setups here as we keep seeing the SKEW perhaps evolve out here in soybeans. All right, let's see. We can probably spend a lot of time here on ags, but I want to get to some of the listeners as well, Mr. Rock Lobster. So without further ado, it's time for a little bit of their futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's Mixlr.com.
All right, listeners, let's see how many of you we can squeeze here on the episode today. Let's start. Raquel. I'd like to have the ladies join us here on the program here. Raquel wants to know, what are some other markets that exhibit similar skew to equity indices? Mr. Rock Lobster, might be an interesting one. Is up your alley. Obviously, you're talking equities. You're talking investment skew, so the put's going to have a nice bid from a vol perspective. The call's going to be probably pretty cheap. Mr. Rock Lobster, any other marketplaces that come to mind when you think of a nice cheap call, rich put scenario, sir?
Jeez Louise. I am trying to think of one. I'm actually taxed to come up with something else on equity skew. I'm thinking the only thing that was kind of coming to mind could be bonds, but I thought there was a little bit of upside curve in that one. So I'm just trying to remember my bond curve. Usually there's a little bit of a bid to the calls. Yeah, there is. So that's it's like it's like we don't have a ton of bonds to issue, but I guess we could run out of them at some point. I'm trying to think what other is depressed because the vol products don't trade like that. There's like more parabolic skew to all the ags. I have to say I'm stumped on thinking of anything that trades in equity skew besides equities and cash indexes.
It's a challenging one because a lot of the commodities in particular, we're just talking about them, their skew is a bit of a moving target, which kind of is what makes them fun. What makes it enjoyable for me to talk about them on a show like this every week is that it's always moving. You know, the calls are bid, the puts are bid. So if you nail them down for one brief window in time, you might get them lining up like an equity skew. But right now, a lot of the commodities have a bid to the upside. We're seeing that in gold. We're just talking about it in soybeans. So they're not lining up that way. But give them time. They will evolve, and they could come back. But right now, there's not a lot. You're right. Leaps to mind to me that shows, you know, a modest sell-off here, and the call volatility and the crude. But in fact, it's funny. I guess if you want to put it in there, we talked about it before. The one that maybe does jump to mind is WTI. We have talked about the weakness of that call wing for quite some time, and the puts have usually been demonstrably bid. So the last few months, you might want to say that WTI is in that bucket with the probable caveat that the call wing, if anything, is even weaker in WTI than it is in the equities. You know, in the E-mini and others, Russell, things could happen to cause those calls to maintain some of their value. We have not seen that in WTI. So if anything, maybe WTI is worse off. But that's one of the ones that kind of jumps to mind a little bit. I don't have it up in front of me right now. We'll have to parse it in a little bit. I want to get some more questions before I start pulling up all these other graphs. I'm already pulling up the next questions and what they're asking about. But off the top of my head, that's one that of late, again, it's a moving target, but of late has shown weakness in the calls and a bid to the puts, which is the kind of ballpark what you're looking for when you're looking for an investment skew. All right, next up, Daly. Daly wants to know, is there an uptick in CME crypto this week? Well, I'm assuming you mean the options because the futures, as we know, are kind of blowing the doors off these days. The Bitcoin futures have been trading a lot. By the way, if you're interested in this stuff, Daily and anybody else, we do a crypto rundown show every week on Monday after the option block. So I encourage you to check out over there and see what's going on. If you listen to that show, you'll notice we did mention there was an uptick. In fact, we had Tim McCourt on this program last week. And we were talking about how, it started off around 50-odd contracts, then it kind of fell off a little bit, and then it started ticking up again. We saw another 50-odd contract day again last week. The futures have been doing well. In fact, right now, the futures are lighting it up, 15, almost 16,000 contracts in that Feb Bitcoin future there. So the futures are on fire. Options, obviously a bit of a laggard there, but we're starting to see more upticks. I was just talking on the crypto rundown earlier this week. We've seen an uptick in notional to around close to 3 million a day some days. I hate quoting notional. Sometimes when the contract volume is that small, that's all you can get, particularly if you're going on platforms like SKEW and others where they parse it in those numbers. So in general, we have seen a bit of an uptick. It's not anywhere near what we're seeing in the futures yet, which is, right now 16,000+ contracts. We're nowhere close to that. But given how much interest there is in the futures, it does seem like the options will be coming along. So yes, short answer to your question, yes, we have seen a bit of an uptick. I'm curious, Mr. Rock Lobster, has this been any narrative for a lot of your hardcores in your pit chat there? Are they been intrigued by the launch? I mean, we had a bunch of other OTC and various international flavors of Bitcoin options. Now there actually is a listed option on an exchange people have heard of that they could trade in Bitcoin. Has that caused any interest in the hardcores in your pit chat there, sir?
It's caused a little bit of interest. I think ultimately it'll become a huge product because Bitcoin doesn't go away. And every time something weird happens, like a bid pops up for the product again. You have all this printing, and I think it still has that kind of mystique. So I think the options will end up being just a huge trader. It's just everybody's going to have to wrap their head around. You coming up with SKEW on how to make those things work and stuff like that. So I think it could be a really cool product. I do know people that have traded the options on Bitcoin and kind of those European funky exchanges that I never quite could figure out, kind of the online exchanges. So I think, it will be a large trader.
Yeah, certainly showing signs of that. I mean, not volume-wise yet, but the percentage is ticking up. So hopefully, again, like I said many times, one of these products on a listed venue people have heard of has to succeed in order for Bitcoin to really take that next leap into the stratosphere, become that big boy market everybody wants it to do. Clearly, the futures are lighting it up. There's interest there. People keep saying it's the multiplier. It's not the multiplier. It's a 5x contract on the future, just like the option. If the multiplier was scaring people off, they wouldn't be trading the future. So it's not the multiplier. So it's something else. It could be other brokers haven't listed it yet. There's always, like we see with the energy weeklies, there's all sorts of devils in the details as to when the options get disseminated and who's trading them. But it seems like slowly the trend is moving up, and that's a good thing. People who want these markets, it doesn't matter what the venue is, want these markets to become big boy markets you could trade with deep liquid markets. They have to succeed somewhere. So let's see if these CME contracts are going to be the one. We got time here. Let's see. We got time for at least one more. Marcus T. Let's see. Marcus T says, I think crude demand will recover in the next 1 to 2 years. What is the best way to be a long-term oil bull? Is it the futures? Is it the options? Is it an ETF? Is it something else? Marcus, interesting question. That you're right. There is ongoing debate right now what impact there is from the virus and others on the long-term demand for crude. We're seeing some pretty drastic steps out of OPEC and others to try to shore that up. We're seeing IEA saying this is the weakest outlook they've had for crude demand since 2011, nearly a decade. So a lot of things pointing to near-term downside. But you're right. Hopefully, if all this goes well with the pandemic, hopefully this crude will recover in the near future. So this raises an interesting point. Mr. Rock Lobster, you were just talking about this before at the top of the show, some of your preferred ways to play crude. What do you think here from Marcus T? Because each of the options, pun intended, that he mentions here has their own challenges, right? The ETPs, I know you like those. They tend to suck long-term because they have all that rolled yield, and a lot of them are constructed kind of crappily, quite frankly. So buying and holding those in the long term, something like a UXO or others, not exactly, I think, a recommendable approach. The futures are intriguing, but also have challenges to them as well, because it's not like buying and holding a stock. You can kind of sit there and set in and forget it. Futures are ticking all the time. That could be a lot for someone to manage, let alone knowing where in the futures curve you want to be and kind of some of the other nuances there. And then the options, they also have challenges get that far out. Liquidity is a little bit harder to come by. Spreads are a little bit wider. So there's challenges with all of these. If you had to pick a preferred route for Mr. Marcus T here, Mr. Rock Lobster, what would you recommend for him?
Oh, dear. I mean, to me, the easiest way is just like long-term stocks, but using WTI like 1x2 put spreads, trying to generate some bucks from those at a price that you want. If you make some money, you go take the bucks you make from that and then buy some long-term stocks, if those are actually starting to perform. Because at some point, you have to think about it, oil has to stop going down. So, you're putting on 1x2 put spreads that could generate some dollars for you. Use the leverage of something like a WTI. Don't over-leverage yourself, obviously. But, so that way oil just sinks and doesn't quite give you that recovery, right? The the put spreads on 1x2s will pay long 1, short 2, thinking that you're going to take, you'll just either roll or do the trade again. For like on a quarterly basis, or probably with crude futures, like a 2-month out option or something like that. And if you actually start making money on those, meaning oil's not really going anywhere yet, right? So those things should start paying. And even if oil slips a little bit, a 1x2 is pretty good because it gives you some room for the contract. And if you actually do start making money on those, then you can take the dollars and just buy, cheap, like big, the big cap oil companies, because they're paying like crazy dividends. So, I think that is a kind of in the meantime strategy that could end up being a longer term strategy. Because oil could sit down here for a year, right? You could sit at 50 for a year and you're not really making any money being long it anyway. So try to figure out a way to generate some bucks from where the options are trading.
Yeah, I like that. That's a good way to play it. Instead of just coming out and blasting out the puts, all of you are saying, what about just selling the puts? So obviously the 1x2 put spread gets you a little bit more cushion, a little bit more wiggle room to the downside if you move to the downside in the near term, not through your strikes. You're doing all right. You're making money on that spread. If you blow through it, you got a little bit more cushion as opposed to just selling that strike. And then, of course, if you do keep going through it, you get long at a level you hopefully you have determined is attractive to you. Now, in the long-term time frame, this is not a trade you want to do super far out. It's more of, in fact, if you want to construct it properly, you want to push the longer portion out, the long premium portion, push the nearer the 2 portion, the short 2 a little bit closer. So then you could kind of keep rolling those every week or every month, maybe getting back some of that action we're seeing right now. Maybe that's what people are up to in the WTI weeklies, because they are tearing it up right now. If you start pushing that out, push the long leg out a little bit, push the near term a little bit closer, and you can keep doing that, rolling that, rinsing and repeating. You can do it for 1 to 2 years. Nothing to say you can't. And maybe along that way, maybe you pick up WTI at an attractive level. You can turn around and wheel it out if you're so inclined, or you want to keep it. Sounds like you want to keep it in this scenario. The other thing you mentioned, you're right. Some of these other ones are a little bit challenging. Definitely not the ETPs. Maybe the long-term basket of some of the crude stocks, like you mentioned, Mr. Rocklofts, is also a way to go. That's easier buy and hold for a lot of people because it's not quite as challenging for some of these other products here. But I think the WTI 1x2 put spreads also a good way to go. I'm looking here really quickly. We were talking about the SKEW before, listeners. Yeah, it looks like WTI. I'm looking at April right now, which was the second most active month, about 25% of the paper. Calls are about 7% cheap, almost 8% cheap at the money. So they're pretty cheap. And the puts are about 7.5% rich. So that does line up pretty nicely with our equity SKEW. But still, interesting stuff here. So WTI may be one place you may want to look if you're looking for other products that have a SKEW setup similar to equities. All right, listeners, that music means we come to the end of another epic journey through the world of futures, options, and all the related things. Now we talked some energy, even got some RBOB on. Never talked about that. Talked a bunch of ags. Never get a chance to talk about those too often. Got some of your questions about crypto. Talked a bunch of equity and volatility. A lot of fun stuff here on the show today, breaking down what was lighting it up in January. But before we go, Mr. Rock Lobster, if folks are intrigued, maybe they want to call you up about 1x2 put spreads in WTI. Maybe they want to do them in some other products as well. Where should they go? What should they do, sir?
Go jump on over to optionpit.com, go to our membership area, and you can check all the stuff that we have on learning about SKEW options, our Edge Hunter sheets, using vol to price stuff. If you want some vol, we got it at Option.
There you go. Somebody even say you have a vol trading club they can join. Get the fancy secret handshake, secret clubhouse, all that good stuff. OptionPit.com is the place to go. And, of course, our buddy Sean couldn't be here. FTSERussell.com, FTSERussell.com, the place to go for all that data you guys like about recon, about premium harvesting, all that good stuff and more. Give him a follow on Twitter as well, at FTSE Russell is the place to go for all that data. And, of course, you know where to go to find CME. CMEgroup.com/TWIFO is the place you want to go if you want to check out those reports in between the shows. I encourage you to do so. A lot of these questions you're asking, you can see the data for yourself there on those reports. CMEgroup.com/TWIFO is the place to go. And on behalf of Mr. Rock Lobster and Sean, who's out there trapped in the snow, and myself, I thank all of you out there for downloading, streaming, subscribing, for sending in such great questions. Keep them coming. We love you guys. We'll see you back here tomorrow for Volatility Views, and then back next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.